Hello, everybody. Welcome to our webinar. Looking forward to our session as always, and excited to see everybody that's here. Hopefully we'll get a few more coming in as we get things rolling, but in any event, it's always good to be at Friday and have an opportunity to talk about the markets and see where things are going. Gib, thank you for giving me the audio and visual check. I appreciate that. And also the compliment. I'll take it as a compliment. You said, "Oh, wise one, I hear and see." So I appreciate that, and that's a fun way to start the weekend. So thank you. All right. As always, I'm unmuting everybody in the GoToWebinar software, and just ask you to manage your microphone settings for me from your side, minimize background noise for everybody else. That said, we do want to have an open conversation and discussion. Victoria, good morning. If you have a comment or a question that you'd like to bring to the group and you don't mind speaking up, just go ahead and turn the microphone on from your side and feel free to chime away. If you prefer, you can use the questions panel. Both Gib and Victoria have already done that for me. That's another way that I'll pay attention to what's going on in the webinar and fold in comments and questions as you have them. So whatever method you prefer to interact with me and with the group is fine. But we do want to try to have an active discussion and lots of participation. So appreciate everybody for being here. And as always, we've got a lot to talk about. So how's everybody doing? Antonio, I see your microphone's on. How are you doing?
Just wanted to say good morning from sunny West Coast.
Yeah, and it's been a little bit less that way out here in Utah, but then again, as hot as it's been lately out in the middle of the desert, it's probably a good thing to get a little water and kind of try to mute some of the heat here. So coming into the dog days of summer, I guess. All right. Well, let's go ahead and dive in. It is, as always, I like to have this webinar on Friday for a couple of reasons. It's a nice way to finish up the week and get into the weekend, number one. Also, options are always expiring on Friday, and so that means that for some of the trades that we're looking at, it's an opportunity to look at where they're at and evaluate if there's something to do with those as they come up on expiration. There aren't any open trades that I have been working with that are set to expire today, but I do have a number on deck for the next couple of weeks, and so we'll be able to take a look at those and see how they are compared to market action for what's happened in just the last few days, and see if that changes the perspective about how to work with them if maybe the opportunity is a little bit different, or if it's a matter of staying the course. I'm sure we'll probably also have some opportunities to talk about some of the other things that you may be looking at and have some interest in. So we'll get things going as we roll through here. Let's go ahead and just to kind of start from the bottoms up. The first trade that I have that is set for expiry today is a put sale on Coterra Energy. Now, this is a stock that many of you know I've used quite a few times, especially just over the last really since the beginning of the year. And this has been one that has worked out pretty nicely for me on a few different occasions. And this is a trade I placed in the middle of July, so about a month ago. Using the $27 strike price, got a little under 2.5% for that period of time. Now, that's been an interesting one to keep track of, just because the stock, oops, I'm sorry, need to select the right one. There we go. The stock is obviously picking up a lot of bearish momentum, even though it is rebounding a little bit here over the last few days since the last earnings report. Now, to be totally clear, I haven't gone back through these numbers yet because some of the data from that earnings report hasn't filtered through yet to the data feeds that I like to use. And to be honest, I'm lazy. if I don't have to actually dig through all of the earnings reports and balance sheets myself, I don't really want to. And so that means that if it means waiting for a couple of extra days to wait for that data to come through, I'm usually okay doing that. And that's kind of been the case with Coterra. But in the meantime, that has meant watching it pick up, quite a bit of bearish momentum here. There we go. And really accelerate downward, especially immediately after the earnings report. So the market certainly didn't respond too nicely to what this earnings report was. Came down and has hit pretty strong support down here, a little bit above $23, and we'll see if it rebounds. But my strike price for this stock was all the way up here. So excuse me, still got a week to expiration, but that's a long ways away from that assignment price by any stretch of the imagination. So that really brings up an interesting question, because sometimes this happens when you're dealing with put sales, and you'll see stocks not only start to pick up bearish momentum like we see coming up here. This was, middle of last week was roughly about here. I wasn't feeling too bad about that at that point, and then all of a sudden, bam! Next 3 days, it was all the way down at 23. So let's talk about that in practical terms as an investor. Some of you may or may not have been in the same trade as I am, but what do you think about that? How do you react when you see that happen?
If when you get a pullback, it's you go on to the next ones. On that, got hit with a few, took a couple losses on those, and reinvested, and then looked at other stocks that hopefully regained what was down, and some work, some don't, but you're going to get those pullback days, but you don't panic, because the news of the jobs market and the
Right.
interest rates, we got hit on Friday, it started, and we're almost back
Right.
to the levels they were.
Right. Right, and that hasn't totally reflected in a stock like CTRA, but I do agree with you there. And a lot of this kind of depends on your method, of course. If you're working with these on kind of maybe a swing trading basis, then hopefully, if you're placing, if you're working on a directional basis, whether you're talking about swing trades, momentum trades, etc., then if you're not using stop losses on some of these stocks, then you're being kind of foolish. Because then you get exposed to what can happen in a very short period of time with a stock like CTRA. And so to your point, Antonio, I think that becomes a lot about the mindset of, okay, that trade didn't work out, I'm out, we move on to the next one, and you look for the next opportunity, right? I totally agree with that. Go ahead.
Your key is those stop loss hits. You can't.
Yep.
And I just the other day I was down one quite a bit, and I'm going, why did it miss us my stop? I forgot my date. It was only for the one day,
Oh,
and I
no.
didn't set my date. So the next day it said blown by the mark, and I said, okay. And then I took a look at it, and then I corrected my stop market, and I actually I put it down another 5%, and fortunately it's come back up a bit. It's come back up to almost where I originally had it. Even though it had taken a 12-15% hit, I'm still about a 4 to 5% down on it, but it came back.
Right, and that's that's a fortunate story, right? Where you know, sometimes sometimes our own individual uh, missteps, I guess, is a good way to put it, right? Where maybe we just don't enter the order right, that ends up working out for you. Okay, but to your point, I appreciate what you're saying about, you know, that stop loss management in those situations really becomes very important, very critical to whether or not you're going to be success. Because if you are placing any kind of directional trades that are different from my normal approach to put selling, which is what I did with CTRA here, you need to operate with the understanding that you're not just going to have some losing trades, you're going to have some losing streaks. Those happen. You'll have batches of losing trades happen, and they'll come in bunches sometimes, and you have to be able to ride through those. And the only way to do it successfully is with really good stop loss management. Now, if you're taking the opposite side of the market, you're the seller rather than the buyer, which is really the emphasis for Rebel Income and the way that I like to work with put sales. You know, my approach is a little bit different here because, you know, here the stock is at 24.09. That's not quite as bad as the absolute low point here. But the truth is, if, you know, in the next week, is the stock suddenly going to rally and push above 27? Well, I'm not going to say that it couldn't, but the odds that it will are really low. It's a lot more likely. Let me just clear out some of all of this confusion for a second. It's a lot more likely to see the stock just kind of start to consolidate a little bit, maybe down here around this low. That means that the odds that if you're in this put sale with me, like Barry is, that you know, I'm going to be looking in all likelihood at an assignment probably at least $3 to $3.50 below the strike price that I sold. And in this case, when this is one of the things that really becomes very critical when you're taking the sell side of the market, is you do need to think about what are the extreme situations that can happen and how do you want to deal with them. I say all the time that I am actively accepting the reality and the possibility that I'm going to be assigned on some of these trades, and that the stock could and likely will at some point drop below, very much below the strike price that I sold. That doesn't that I don't shy away from that, because it really always comes back down to how I feel about the company. And Ray likes to use this term a lot, right? Where we're talking about legacy stocks. Is this a stock that I would be willing to hold on a very long-term basis? If the answer to that is no, then you're never going to see me actually use that stock in my put selling system. So anytime I'm doing these, not only am I accepting the possibility of an assignment, I'm saying I would be okay with that, even if the stock is significantly below, excuse me. So that is the normal mindset that I'm working with when it comes to Coterra, but you know, not everybody is going to be the same, and that's okay. If you want to be a little bit more active about this, some of the other people in our group who have been maybe a little bit more active about wanting to manage these trades, you know, this period right here may not have been too much of a concern, but certainly by the time we hit this would probably, if our good friend Joe were in this session right now, or some of the other people that have that really prefer to manage these income trades more actively, excuse me, they would have bought bought the $27 strike back from the market by now, to try to minimize the potential loss as much as possible, and that's perfectly fine. So today, or even 2 weeks from now, would be a non-issue. They would already be out of it and moving on. So this really does become about what your attitude is towards the stock, what's your method of management of the trade is going to be. And this is the other reason that I really keep beating my, this position sizing drum as hard as I do. This is a stock that I only sold 2 contracts on, and with a $27 strike price, that means that my total obligation is $5,400 on an account that is a little bit above 288,000. That's a relatively small portion of the account, and so it doesn't necessarily it doesn't make the fact that the stock is going to be that I'm likely to be assigned the stock at a much lower price. It doesn't necessarily make that more attractive, but it does make it a little bit easier to keep in an objective context and think about it in more practical terms. All right, Barry, you said I'm still in from the April 19th assignment at 28.50. So, there again, thank you, Barry. Here's another example. I'm in at 27 on this, again, assuming I am assigned, right? Here's me. And here's Barry. So this really becomes the critical question. How do you feel about the stock? Are the fundamentals still in place? Is the value proposition still attractive? Now, again, there is a new set of fundamental data to work through here that I haven't had a chance to go through myself yet on Coterra, but I am going to be that is going to be a point of focus, is making sure, going back through this and seeing if what we're seeing from this great big drop is what it is likely to be, which is mostly an overreaction. If that appears to be the case, then that's in my mind at least, a good reason to stay the course. If it is indicative of maybe larger problems, then that may change the evaluation and therefore the conclusion. So it'll be interesting to see. Gibbs says it was an exciting Monday. Any thoughts? That's a good question.
That's an understatement.
And so here's the S&P 500. Here's Monday. This was Friday. This was a week ago. So let's throw that out to the group. What are your thoughts?
It was necessary with the run that's been going in the market. The pullback, we talked about it last week too, as institutions need better buys, better bargain pricing on the big ones, so they have to readjust, because they can't have so much of one stock when it goes up so high. So they have to eventually readjust when everything's going up.
Yep, there is a lot of truth to what you're saying, and everybody wants to start scream. Forgive me for going back to a child's story here, but I've got grandkids, so everybody wants to start screaming the sky is falling, right? And there is really a big, these kind of feel like a little bit of a gut punch in the moment when they're happening, right? But it is really important in these cases to try to put them in the broader context. And I appreciate what Antonio just said. When we think about much longer trends, these are really actually very healthy. They're really, that's why they're called corrections and not something more dramatic sounding, because this is profit taking from people who have enjoyed these longer runs, and I'm not necessarily saying those who got in November and now they're up here and now they're selling. We don't know that for sure. But what this does is it puts these much longer term moves in a different kind of context. I'm going to shift my line a little bit. There we go. And that this is a Fibonacci trend line that I've drawn. So this is the trend. And then the lines that we see, each of these lines are a percentage measurement based on the length of this overall trend. That's how Fibonacci retracement levels are calculated. So this is the 38.2% retracement line, which is very often in long-term trends, whether they're upward or downward, this 38.2% retracement line is often considered to be a major point where a major point of support for the longer trend, first of all. In other words, if the market continues to retrace here, it should find really strong support right around 4,900 if we're using this trend as our reference point. And also very likely to find, if this doesn't hold for whatever reason, then it should find support here. Now, with that in mind, this is about 43.50, roughly, a little bit above that. To put that in context as to what that means in terms of the overall size of the decline, just how dramatic a change is that in the market, well, we're going to have to do a little bit of maths. So give me just a second. Get my mouse back. So if we have the top at, what is this? $56.69. And then we have our 38.2% is 48.62. Okay, that's an 800-point drop. That sounds like an awful lot. And again, in a very, very short period of time, that's going to look pretty serious. We're certainly going to see a lot of talking heads starting to get a lot more concerned. Sorry, I just messed up my own maths while I was talking. This is why I need to be careful about talking while I'm doing this stuff. 5669 minus 4862. Okay, 807. So then we divide that by 4862. Actually, that was wrong. I divided that by the wrong number. 5669. Ha 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 ha. I can do this. Some of you probably already have these numbers. You're just waiting for me to catch up. So this is about 14%. Is what this number would mark in terms of it. If it drops, if the market drops this far, there we go, drops down to here, this is a 14% decline from this high. That sounds scary, but it's still not a bear market. It still really only falls into the category of a correction. So what does that mean about this level, which was about 5,200, where the market had topped at a level a bit higher than that? Again, we're talking about a peak at what was it, 56.69? Yep. So we're talking about a little over 450 points from this top to this week's low point. That is, excuse me, less than 10%, right? 5669 minus 5200. Oh, geez. There. So it is about 10%. That's the minimum level to start defining a correction. And that's part of the reason we're seeing a rebound from that point is, traders recognize these levels and they will adjust their positions accordingly around those levels. So market corrects about 10% of the time, or about 10% from a high. Then a lot of technicians are going to say, all right, correction is done, and it's time to and now it's a good opportunity to start buying, because as Antonio was saying, now a lot of these stocks are available now at pretty nicely discounted prices, and that's going to be an opportunity. And that is at least part, not necessarily all, but it is part of the reason that we're starting to see this rebound. I'm not quite ready to call it a rally just yet, but that's what this is, at least in part. So
Yeah, my number in that. Sorry.
Go ahead.
I was going to say my number of scared is the 50-50 number line. That's where if that's where I'm going to be very, very cognizant of where the market's going up or down, is where I drew my line is the 5050 mark.
So right around there, and that is an interesting level, isn't it? We've got a lot of activity right here. So I would expect some stabilization probably in that region as well. And a drop below this, this would be a drop below pretty major support. That would be an interesting signal point, not necessarily calling for a correction yet, but that would still, again, if this is 10%, right, then where you're talking about, Antonio, is a little bit below that. And that does mean that there could be some acceleration of the correction. But even with that in mind, again, keeping these these generally accepted numbers in mind, 5669 times 0.8. Remember, excuse me, bear market isn't really acknowledged until you've seen the broad indices decline by at least 20%, and that level is all the way down here at 45.35. So even with your signal point, Antonio, which I agree with, if we see a break below that, we could see an acceleration of bearish momentum, but it's still really just an extension of the correction when all is said and done. And we really need to see, it needs to be all the way down to here before, now we're talking about bear markets.
A serious bear market.
Well, this is the minimum level to start calling anything a bear market. Yeah. As serious as this sounds, and as serious as this distance looks, I'm going to change my color because I don't want to. This is still just a correction. Corrections between 10 to 20%. Again, they aren't. They sound more serious, and they are, because you're starting to see. You're going to see some stocks extend some downward moves and downward trends in those cases. So some of those losses start to become a little bit more accelerated. But even these more serious corrections, ultimately, in the context of longer, broader bullish trends, they're not out of the ordinary. So, all right. So we have a lot of room to go. This doesn't necessarily mean that you don't think about how this translates to the positions that you're in. It just means that I'm not ready to say that the sky is falling yet. I'm not ready to be as concerned about whether or not the market is going to become clearly and categorically bearish just yet. We're not quite there.
I'm with you.
But that said, we should be more cautious. We should be more selective about taking on new positions. That could 100% mean I know, Ray is a good example of pointing out that a lot of the trades that I might write about that you'll see me place, he'll say, yeah, I didn't like it. It wasn't good enough for me. I love that mindset, because we have to each take the information that we're getting, whatever the source is, and we have to compare that against what it is that we're wanting to do at any given time. And especially when conditions are becoming a little bit more volatile, a little bit more emotional, then the times to start thinking about this even more critically are right now. And so it becomes even more appropriate to do that and to apply a really, really critical eye to the things that you're thinking about doing. So whether you're following me exactly or not, I hope that you're trying to put all of this information into a broader context in terms of the way that you think how it translates to what you're going to do. One of our other friends that's been in this, hasn't been in this group for a little while, Carl, always like to talk about the sleep test. And that's an idea that I come back to a lot myself. If you're ever in a situation where you think that taking on a trade, whether it's coming from me or anybody else, is going to make you sit up at night and wonder what's going to happen next, then maybe don't place that trade. And whether that's a function of the information that you're getting or the system that you're putting in place and the way that you're managing it, that idea of being able to sleep at night with the decisions that you're making is a really, really good point. Ray, you just turned on your mic. You have a comment?
Yeah, I just want to make a comment, Thomas. When I first started doing this with you, I used to ride that mule quite a bit. But what I learned over the last few years is that, especially this time of the year when we expect the market to go down, in August, September, is what I do is I push my my sales out a month to a month and a half. I get bigger premiums and I get lower assignment prices by doing that, and it allows the market to be volatile. Like in these last few days, I mean, I have all kinds of puts that I have waiting, and they've gone in both directions now, with this volatility, and I'm still just holding on and waiting for them to come around to, what I expect them to be once this mess is done. But at the same time, I'm still collecting big premium. So it kind of takes my worry out of the volatility, because this thing, you just can't tell where it's going to be tomorrow.
Right. Well, I love that variation on a theme. You hear me talk a lot about leveraging shorter term trades so that you can accelerate the compounding effect on your income generation, and that's still the one of the primary themes that I focus on even under these conditions. But isn't it interesting that Ray just suggested a little bit of a different wrinkle, where maybe selling a little bit more time, because you're able to bring in larger premiums for that, also gives you an ability to sell more conservative strike prices. So if we go back to Coterra, under the same circumstance, and maybe a more conservative approach than what I did with this trade, because when I placed this trade, we knew we had this earnings report coming up, and I said, if you don't like the idea of holding a put sell through an earnings announcement, don't make the trade. But maybe another more conservative twist on the theme, maybe sell a little bit more time, bring in a little bit more premium, And maybe instead of selling, again, I'm literally pulling numbers. I'm literally pulling numbers out of the air. So, you know, don't take any of these as official or recommendations or whatever. But maybe instead of selling 27 as I did, maybe I'm able to sell, I don't know, 26, maybe 25.50. It doesn't totally, again, it doesn't completely, you know, change the dynamic of what this movement is, but it does change my trade's context quite a bit.
Well, and
And
the other thing is a lot of times after earnings, you get an earnings reaction, which I think this is on Coterra, right? So
right,
that reaction, that steep drop, will probably recover, at least fill the gap. So if you'd have taken like a 25.50, for example, maybe by September, that 25.50, it may be back over that, or it may be a lot closer to what your price is, which I've taken a lot of different trades where right now I'm underwater on because, you know, they're down, but I expect by September, October, you know, whenever this thing comes back around, either I'll get assigned, which is good because I will have gotten assigned at a good price, but
yep,
in either case, you know, it gives the market a chance to do its thing and come back to you.
right. Now, by selling a little bit more time, you are sacrificing some of that compounding effect. But again, let's, you know, think about the advantages here that Ray is talking about. You are bringing in a little more premium up front, and maybe even a lot, depending on the stock. You're also able to make the trade more conservative. So maybe if I am able to go down here to 25.50, you know, seeing the stock now at a little bit below 24.50, if this is my strike price and I'm out to September, as Ray is suggesting, well, you know, maybe the emotion of that evaluation is and ought to be quite a bit different than it would be if I'm looking at 27 next week. Just
Yeah,
saying.
I did that with Palantir. You know, I know
Okay.
it's not a one of your stocks because it doesn't pay the dividend, but
Right.
you know, the earnings was coming up on Palantir and I didn't know which way it would go, but I know that the intrinsic value of it is quite a bit, you know, higher than what it was. The price was at the time. So I took Palantir at 24, you know,
Oh, wow.
and after earnings, it took off. So I'm not going to
Right.
get a Palantir, but I got quite a bit of premium because I took it for September 6th.
Oh,
And so
yeah.
I wrote it through its earnings, and now, you know, it's going towards being, you know, worthless, and I'll just keep my premium.
Yeah. That's really interesting. And that's a win. That's a nice, that's again, it's just a different variation on the same theme that we're talking about. So there's all kinds of ways that you can change this up and adapt to different conditions. You don't have to always apply exactly the same method. If you feel like there's another way to do it that puts you in a little bit different position. So I appreciate that. Thank you, Ray.
And Palantir is one of my parabolic stocks.
Yeah,
It has been for.
I got some at $9, so I'm good.
I was going to say it's been that way for more than a few people for sure. So even the dedicated dividend hunter like me has taken notice of this stock. So all right. Not saying that I have a position because I don't, but I have noticed. All right, so that's Coterra. Let's see, I do have a covered call on Conagra, stock that I was assigned back here in May at 30, and selling the same strike price as what I was assigned at. brought in a little over 1.5%. Again, this is for a 1 month trade on this one. So let's just check in with Conagra really quickly. Again, the week's volatility has been interesting on this one. Last week when at the same time, it was up here around 31, looking pretty good. Still looking pretty good, still above 30 in this case, and generally tracing nicely along, the 20-day moving average here, which is trending upward. So it's following that support. It is interesting, with a week to expiration, here's 31 is pretty solid resistance. So it's not far away from that. So we'll see what happens in terms of where that works out. But again, we have nice earnings report, recently got a dividend on this one. And so, if I ended up holding this a little bit longer because it finishes below 30, that's okay. I'll take that. I'll have another opportunity to work with it, maybe in another context. So maybe another covered call, who knows? Let's see, let's again go back to our put sales. We have KHC, so here is Kraft Heinz. I sold 32.50, brought in, again, this is about a 3-week trade, brought in about 2.3%. This is a pretty nice one, and it's been a couple of days since I looked in on this one, but it was moving pretty nicely. Again, the week has taken it off of its highs up here around 36. Again, I sold 32.50, so it would have to get all the way down to here within the next few days, within the next 7 days to be precise, in order for me to be assigned. That doesn't look very likely. It is possible, I can't completely dismiss it, but as of now, that still looks pretty attractive. So let's go ahead and check in on this one.
Nice moving average crossover on this one.
Yeah, for sure. That's a, you're talking about the 20 and the 50?
Yep.
So I took the 50 off here, so let's take a look at that one. All right. Yeah, and that happened back here at the latter part of July, right? That's given that a lot of lift. But if some of this momentum continues, then we'll see the 50-day. Let me just, oops, that's a 9-day. This is where I get ahead of myself, or allow my mouth to get ahead of me, I guess. There we go. Okay, so actually, you're exactly right. Thank you, Antonio. Right here, this is actually earlier. This is the beginning of the week. 20-day crossing above the 50-day. That is a bullish indicator. That is also supporting this rally since mid-July. And is this providing support or resistance? Well, mostly resistance right now. We'll see. But this also means that the distance between support and resistance, which is right about 34. Here's resistance. This is starting to narrow a little bit. So overall, that looks very interesting, to be sure.
And all of them are turning up.
Yep. Yeah. This is a little tick up, right? This is obviously up, and even with the market has been really volatile. Look at the 200-day moving average on KHC. So all of those are very interesting, to be sure. So this looks interesting. This looks pretty favorable, obviously, and that's kind of nice. Here is the 32.50 strike price for next week. Again, I sold this for 75 cents. I missed Joe, but I'm not gonna lie. I'm not sure I miss what he would be doing right now to see this. Joe, if you listen to the recording here, no, I'm throwing a little bit of shade your way, but it's all in fun because this is pretty interesting, isn't it? I sold for 75. I could buy it back right now for 4 cents and not even monkey with the market, and I would get that almost immediately. That's keeping about 95% of the premium with still a week to go. That's interesting. And if we think about rolling, and if you're willing to be a little bit aggressive right now with the stock up here at about 35.29, this is not extremely aggressive, but a little bit. For 7 more days, you could buy this back again, not a recommendation, but here's buying this back, hang on to 71 cents of your premium, then turn around and sell for 44 cents at 35.50, which is only about 21 cents out of the money right now. And if the market, if this stock maintains that bullish momentum, that could just simply expire worthless as well. Again, not saying what anybody should do. I'm just saying, if you're thinking about this from the standpoint of kind of that rolling method that we've seen, and that I like to talk about and revisit, that's not nothing. That's actually kind of nice. So, any other thoughts on Kraft Heinz?
What if you were to look at an expiration date 3 or 4 months down the road on Kraft Heinz?
So let's do that. Let's go out. Let's expand this view to 20 days, and I'll go to 8 strikes. So here's 49 days. So this is not quite 2 months, right? So it's a little shy of that. But again, if we're talking about, are you talking about this in terms of income generation, or are you talking about more of kind of a swing or momentum kind of a trade?
Well, so I think Kraft Heinz is an awesome buy. I think it's a bargain for myself right now in looking at it. And I'm looking
Right.
at in 2 to 3 months, I really think the price is going to get past the $37 mark. So
Okay.
how would I attack that in an options trade?
Boy, a couple of different ways, right? If you wanted to think about it in directional terms, and you're talking about primarily buying, say in this case, you're clearly bullish, that would mean buying calls, right?
Mm-hmm.
I would probably, speaking again for myself, buying 49 days of time would be really aggressive. So I would probably start at minimum at 70 days. So I'd want at least 2 months to buy out in that case. And again, speaking from my preference, if and when I go directional, I usually want to buy more time than I think I need, and I usually want to buy. I'm willing to pay a little bit more in premium for those options to be a little bit more in the money. So if your forecast is 37, and how long? Give me the time frame again.
3 months.
3 months.
Within.
So we need to go out a little bit further than 70 days. So we go out to December in that case. Here's 35. I pay $1.91, right? But the potential opportunity there, if you're right, this is actually about a 4-month trade, so it's a little bit further out than what you're talking about, and that means that we can kind of try to guesstimate the size of the move here a little bit that this option would see. Here we go. We know that the delta for this is 0.54, meaning that for every $1 that the stock moves, the option is going to change by 54 cents. So if you're right, and you're going directional on this, we just do, let's see, stock now is, we said, sorry, let me just double check my price. 35.30, you're saying above 37. So we'll go with $1.70 away, right? $1.70 times 0.54. That's about 92 cents is how much of a change you would see in the options price. So if you're buying it for $1.98, this is not counting the effect of time decay. And a lot of this move would depend on how quickly it happened. But if you could get 92 cents on top of the $1.98 you would pay to buy that option right now, I mean, that's not quite 50%. That's not terrible. So that would be a directional way to think about it. And you could make it more aggressive or conservative by either compressing the amount of time, maybe going closer to in the money, or selling more time if you wanted to be more conservative. We can also think about it from the selling side. And again, if your perspective, your forecast for that period is above 37, again, my preference here is, if I'm going to talk about put selling, I am going to want to work with generally shorter time periods. But you know, here is 1 month out, the $35 strike. You can bring in 63 cents in premium right now. Again, if your overall forecast is 37 within a couple of months, then the idea of getting assigned at 35 shouldn't be too much of a problem, right? And so the question then becomes, does 1.8% in terms of income generated off of that put sale for 1 month, is that attractive enough to maybe open up the possibility for that, to make that trade? If you did, you've got that 63 cents, your actual cost basis is going to go down to, what is that, 34, 37.
7.
Sometimes math in my head works. But you know, that's also not terrible. And if you prefer, if you're just that convinced about it, then you can always just buy the stock at current price and look for it to rally. There is a dividend coming up here at the end of August of 40 cents. If I place that put sale, that expired, I'm going to say at the same time, right? This one expired September 6th, excuse me. So, you know, if the stock is above 35 on August 30th, you know, then you know, there's no chance of being assigned in that case. So there's a very high likelihood that that September put sale, you know, all of the income you'd have would be coming from the put sale. There's no opportunity to capture that dividend.
Love the
But then
analysis.
again, but again, you're talking 63 cents versus 40 cents. You know, what do you think is going to be more beneficial? So yeah, a lot of different ways to think about it for sure. And again, on a good company at a nice bargain price like Kraft Heinz, I don't see any of these as bad options. These are all interesting options, right? They're just different choices. So you get to pick. It's like picking, you know, picking whatever you want. Just to draw a little bit of an analogy, when my wife and I were talking about getting married, she was considering marrying me versus going going on a service mission for our church. And she went to the leader of her congregation at the time. She was a little bit conflicted. She wasn't sure which one was the right thing to do, and so he asked her a couple of different questions, about me, about the desire to do this service. And when all was said and done, he said, "It sounds like you have a choice between two really good things." And the great thing about that is that you get to choose whatever your heart wants. And this is obviously not exactly the same kind of situation, but everything we've been talking about for these different options with Kraft Heinz, they all look interesting. They all look attractive. And that means you get to choose the one that you like best. You don't have to do what I do. You don't have to do what Antonio does or anybody else. You get to pick the one that makes the most sense to you. And if you don't like Kraft Heinz, that's okay too. So
The one thing that's really good about both the options and swing trader is, as you alluded earlier, is those stop hits mitigate your loss, and usually you're going to be safer.
Yeah. Yep. Another comment here from Antonio. Very strong performance from ENB. So we'll take. We can wrap up on these couple of notes that you gave me, Antonio. I appreciate it. Oh boy, look at that. Here's your favorite pattern, Antonio. Right? Parabolic. That's nice.
On a dividend paying stock.
Right. Yeah, that is really interesting. For speaking personally for me, the interesting about Enbridge is after you brought it up in this webinar, we found out that Enbridge bought our natural gas provider in our area. So they've become a part of my watch list for multiple reasons. They're the ones that are sending me my natural gas bills now. So let's see. New one that he wants to take a look at is PH. We're at time, but we can wrap up on this one. Parker Hannifin, okay. Dividend paying stock with a long upward trend. Look at that. It is a little below the 50-day moving average right now, but it looks like it's bouncing off of the 200-day moving average, which is very interesting. Again, brand new earnings report. I can't speak to what this is in terms of bargain opportunity or not. This has not been part of my watch list. Also, for a lot of the people in our group, this may not be a stock that is practical just because of the price, but if you have room in your account for this kind of stock, this could be very, very interesting. Certainly the long-term trend is very favorable, isn't it? Going all the way back to 2023.
It's a huge cash flow machine. Well, if you take a look even longer, way back to 2010, it was down at $60 or it was $60 price in the 2010 range. I think it hit that bound in 2011 as well. But it's earning stability. Well, and then it did drop back down to 100 on a big hit. When was that? Back in 2020 when everything took a hit. But
right.
But it didn't take long within the year to bounce back to the levels it was, and paying at a moderate 1.15. But the earning stability, when I look at dividend stocks, earning stability is a big number, is something large I look at. That's why I like Viper Energy or Enbridge. And this Parker Hannifin came up as a very high earning stability company. So
Here's one of the things that I like to look at related to what you're talking about in terms of earnings stability. Let's expand this a little bit. Come on. There we go. Dividends. And I need to get rid of this for a minute. But these payout ratios, notice what this looks like over the last few years. So it actually increased. Payout ratio, this is the percentage of earnings, of annual earnings that their dividend payout represents. And so this was about 40, almost 44% at the end of 2022, but it's decreased in each of the last couple of years, and now it's down below 30%. And usually, you know, anything below 50 is really easy to maintain and sustain in terms of the quality of the dividend. And so their dividend has been increasing. Look at this. This is interesting. They've been increasing their dividend every single year while the payout ratio has been going down. Increasing the dividend while it is also at the same time becoming more and more stable. The dividend yield here doesn't look as attractive just because of the way the stock's price has moved. But this is an increasing dividend with increasing profitability at the same time. That's really interesting. That's very strong. So, all right.
As you like to warn, though, it's got a slight overhead from that drop and a little blip, and concerned of head and shoulders and things. But yeah, the long-term stability has been it's proven itself in the stock.
Yep. And this could be. It does look like, you know, I drew this line a minute ago. This does look like a break above resistance in the last 2 days. There's a gap on these earnings. It's going to be really interesting to see what next week looks like if it continues to follow through on this strength, or if it starts to drop back and maybe potentially fill this gap a little bit. So, but as always, very interesting stuff. So, love it. All right. Well, everybody, I appreciate your time as always. Thank you for your participation, your comments. Please do, if you have anything that comes up between now and next week, don't hesitate to let me know. Email me at thomas@investive.co. I'll try to respond just as soon as I can. And otherwise, have a wonderful weekend. I hope that everybody has a great week as well. And we'll talk again next Friday. Thank you, Victoria.
Cheers, everybody. Have a good day.
Thanks.
Trading.
See you, Ray.